What are ETFs? ETFs, or exchange-traded funds, are investment funds that pool money from various investors and are managed by a fund manager. These funds invest in a range of asset classes, including equities, debt, commodities, and more, depending on their specific focus. The price of an ETF fluctuates based on the net asset value, NAV, of the underlying assets and changes daily in response to market conditions. Since ETFs are traded like shares, their quoted price may reflect either a premium or a discount relative to their NAV. Investors are drawn to ETFs primarily for their low costs and the ability to gain exposure to a specific asset pool managed by professionals. ETFs can also serve as indicators of market sentiment in particular sectors or commodities, as they are actively traded during market hours, reflecting the latest information. The popularity of ETFs has spurred the launch of new and innovative funds. Active versus passive ETFs. The ETF market has seen a divide between active and passive management strategies. Passive ETFs aim to replicate the performance of a benchmark index, making them cost-effective and popular among investors, including notable figures like Warren Buffett and John C. Bogle, founder of Vanguard. Conversely, active ETFs do not track a benchmark, allowing fund managers to attempt to outperform the broader market through strategic investment decisions based on sectors, countries, or asset classes. Types of ETFs. Sector ETFs focus on specific sectors like technology or consumer goods, and trade on stock exchanges like index funds. Equity ETFs primarily invest in stocks, either independently or indexed to a specific benchmark. Fixed income ETFs invest in fixed income instruments such as bonds and pay distributions from interest earned. Commodity ETFs invest in physical commodities like gold or oil, providing exposure to tangible assets. Short ETFs, also known as inverse ETFs, they profit when the underlying benchmark falls, holding short positions to capitalize on price declines. Leveraged ETFs use derivatives to amplify returns and risks, potentially enhancing gains or losses significantly. Why investors prefer ETFs? The appeal of ETFs lies in several factors: low cost and no minimum investment. ETFs typically have lower fees than traditional mutual funds and often no minimum investment requirements, attracting a broader range of investors. Targeted exposure. They allow investors to access specific asset classes, such as gold or technology, enhancing portfolio strategies. Portfolio diversification. ETFs facilitate diversification across various sectors or indices at a lower cost, reducing risk in concentrated portfolios. Accessibility. Trading on stock exchanges increases investor participation and liquidity, making ETFs an appealing choice for many. The robust growth and versatility of ETFs continue to make them a favored investment vehicle among diverse investor groups.